There has been a huge trend on Twitter in recent months surrounding dividend investing. But dividend investing, by its very nature, is not going to make you rich. It may not be enough to build up a significant retirement balance to be able to live off of later in life. Unless you go all the way back to like the 1960s and 70s, then it definitely will do just that. But if you kept only focusing on dividend paying stocks in your portfolio through the year 2000, you would have fallen behind the market pretty significantly. Since investing often is a long-term journey, we might look to the long-term charts of dividend payers or dividend growers versus the general stock market. And what you'll see is that if you reinvest those dividends, dividend payers will compound a much higher total return over a long period of time. However, growth stocks, many of which do not pay dividends, have had sequences of returns for 15 years or more where they basically dominate dividend paying stocks in terms of total return. So if you were someone who retired in the year 2021, you would have certainly needed non-dividend paying stocks to earn enough return to match what the stock market is doing, which should give you that long-term growth rate that you've been hoping to earn. Does that all sound like conflicting information? Because it definitely is. And if you can pick up on the trend there, what you see throughout history is that dividend paying stocks, or maybe even more specifically value oriented stocks, will have periods of time where they drastically outperform growth stocks. And then over the next 7 to 15 years, that trend seems to go the other way, and growth stocks will drastically outperform dividend or value stocks. And we can sum up that relationship right here. You can see that it's never a one-sided equation. Our capitalist economy here in the United States does not only allow for one business model, or I'll say one type of business, to do very well in terms of annual returns. Every type of business has the potential to do very well in a 1 to 5 year period of time. It sort of depends on the economic environment that we're in. And as an investor, you never want to miss any of those big, strong runs. So how do we know which one's going to run? Well, there are different theories that can try to answer that question, but the most honest, or maybe the best answer, is that you can never truly know which area of the market is going to be in favor during any 1 year period, or any even 5 year period for that matter. I don't know if all of these people on Twitter who are talking about investing in dividend stocks all the time, I don't know if they just think that growth is about to come out of favor and value stocks, and more specifically dividend growers, are going to be the stocks that earn the highest total return over the next decade, because there could be some argument to be made there. I just don't really hear them making that. Instead, it seems like this trend has caught fire because some people are sort of realizing that there are stocks that pay you a yield in the form of a dividend, rather than a stock that is only going to go up or down in price. And don't get me wrong, a stock paying a dividend, especially when you can reinvest that dividend, is a big advantage. It should theoretically almost always allow for higher total returns. In reality, though, we have seen many instances in the last century where markets do not reward dividend payers in terms of their stock price or their company value, and instead companies that are spending the most and innovating the most and potentially growing revenues the most, that is growth companies, will see their stock prices shoot up. The general argument that these dividend focused investors need to realize is that only buying high dividend paying stocks is almost never going to generate the types of portfolio returns that you would hope to achieve to build wealth and then ultimately live off of that wealth later on in life. Similarly, you typically can't do the same only investing in growth stocks. I've told clients of mine that over the past decade have allowed their portfolios to be highly concentrated in the FANG stocks, right? Facebook, Apple, Amazon, Netflix, Google, Microsoft, you could throw in that category. The message has been, hey, this portfolio has done great over the last decade. The market could shift directions though, and these stocks may underperform. You really need to have a diversified portfolio if you want to have any degree of predictability about your stream of returns over a long period of time. And that is really the gist of this video. The only way that you can consistently and predictably know that you should be able to count on a certain percentage return over a long period of time that is commensurate with what the market has averaged is by being diversified. Because if you're heavily weighted in dividend stocks, you're going to have up periods and you're going to have down periods. And what studies have shown is that those ups and downs don't quite necessarily always add up to a more consistent, stable return. And the same can be said with growth stocks. If you had most of your portfolio in growth stocks in February of 2000, you may have lost like 85% of your portfolio value. Obviously, for someone close to retirement, that is not ideal. You may have to work for another 20 years and build up a new retirement fund to recover from that. Now, actually being diversified and doing this, what I would call the right way, isn't always fun, because you're always going to see people on the internet either talking about only investing in these dividend growers like I've seen recently, or like 2 years ago, talking about only investing in ARK by Cathie Woods because it's the most innovative high growth tech companies out there. And you're always going to feel like you are missing out on a little bit. You're going to get some serious FOMO. One way I heard it described, and if you're someone who might suffer from that type of FOMO that I just mentioned, really try to internalize this next quote. The quote is that you're not truly diversified if you don't hate at least one piece of your portfolio. And that quote illustrates that if every position in your portfolio is doing well during a certain time period, then it's likely that those things are correlated to one another, and they could also similarly do just as poorly if the market changed directions. That could be all in growth stocks or all in value or dividend payers. So it just depends on what environment we just had over the past 5 to 10 years. Now, if you're more diversified, even only talking about the stock market still, and you have some growth-oriented investments and some value-oriented investments, you'll find that you can get a more predictable and evened out stream of returns, because even as the chart showed that different sectors of the market will go way into and then way out of favor, you're going to have some of both in a diversified portfolio. You're going to be able to benefit from both when they have their upside runs, and you're also going to be protected from either of them when they have their out of favor moments. And that is going to smooth out the sequence of returns that you earn year after year. And again, those studies have shown that typically the smoother and more predictable sequenced returns is what is going to give you a larger portfolio value when you go to actually start using that money in retirement. I'm not at all hating on dividend paying stocks. I actually consider myself to be a little bit more of a value investor, if I'm being honest, but a diversified portfolio needs both value and growth stocks. Don't listen to what all of these dividend only investors on Twitter are talking about. And don't listen to what Cathie Wood is always talking about, at least not for your entire portfolio. Each of those can be a piece of the puzzle, but remember, if there's not at least one part of your portfolio that you hate, you're not truly diversified. So consider that quote every time you ever log into your investment account and look at your statement and you plan out for how you're going to build wealth over the rest of your life. As always, thanks for watching.